Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Revolving credit facilities are a flexible financing solution that can simplify business operations by providing continuous access to funds. Designed to support your company's growth, this type of funding allows you to borrow, repay, and borrow again up to a specified limit, making it easy to manage short-term cash flow needs and seize new opportunities. Unlike traditional term loans, which have a fixed payment schedule, revolving credit facilities offer dynamic repayment options, giving you the freedom to adjust your borrowing and repayment strategies as your business evolves. Understanding revolving credit facilities. Revolving credit facilities are a flexible financing option that enables businesses like yours to access pre-approved funds, as needed for operations or growth. Revolving credit facilities are a type of credit facility offered by banks or financial institutions. In this section, you will learn how revolving credit facilities work and their advantages for your business. A revolving credit facility is similar to a business overdraft. It has an established maximum amount set by the lender, and you can access the funds anytime your business requires them. The lender will set a credit limit, and your access to the credit line automatically replenishes as you repay the borrowed amount, either in part or in full. One advantage of a revolving credit facility is flexibility. You can use the funds for various purposes, such as financing working capital, managing cash flow, or making investments in your business. This way, you can better adapt to changing market conditions and seize growth opportunities. Another benefit of revolving credit is that you only pay interest on the amount you draw and use, rather than the entire credit limit. This feature can help reduce interest costs for your business and provide more efficient cash management. However, keep in mind that revolving credit facilities might come with setup fees, commitment fees, or other charges. In addition, the lender may require collateral or other security to back the credit facility. Revolving credit facilities can be a valuable resource for businesses seeking flexibility and a means to better manage cash flow. By understanding how these facilities work and carefully evaluating the associated costs and benefits, you can determine if a revolving credit facility is the right financing solution for your business. Features of revolving credit facilities. When managing your business finances, a revolving credit facility can offer both flexibility and a sense of security. Here, we'll discuss the key features of revolving credit facilities and how they can provide working capital to support your business growth. One major advantage of a revolving credit facility is its flexibility. Unlike a traditional term loan, you can access the funds as and when you need them, up to an agreed credit limit. This allows you to better manage your cash flow, since you're only paying interest on the amount borrowed at any given time. For example, if your business experiences a sudden increase in demand for stock, you can draw on your revolving credit facility to meet those needs without having to apply for a new loan one. Revolving credit facilities typically offer a variable term. This means you can repay the borrowed amount whenever it suits your business's financial situation, as long as you remain within the facility's agreed-upon time frame. This flexibility in repayment allows you to align your borrowing with fluctuating cash flow, ensuring that you can meet your other financial obligations without feeling constrained too. Another key feature is the credit limit. Your credit limit is the maximum amount you can borrow at any given time, often based on an assessment of your business's creditworthiness and financial stability. By knowing your credit limit, you can plan for future expenses and make informed decisions about how best to grow your business. 3. A revolving credit facility is often used for financing working capital. This can include covering short-term expenses like payroll, inventory, and accounts payable. Having this financial resource in place can help you maintain operational efficiency and avoid unnecessary disruptions in your business. In summary, revolving credit facilities offer exceptional flexibility, allowing you to draw on funds as needed, up to a set credit limit, and repay at your own pace. By providing working capital, this financial tool can support your business in meeting its short-term obligations and promoting sustainable growth. Advantages and disadvantages. When considering a revolving credit facility, RCF, for your business, it's essential to weigh both the advantages and disadvantages to make an informed decision. One of the main advantages of an RCF is its convenience. It provides you with immediate access to funds when needed, allowing you to manage your cash flow effectively. You can draw down and repay funds up to your credit limit as and when you require, providing excellent flexibility in managing your finances. Another advantage is the control it offers. With an RCF, you only pay interest on the amount you have borrowed, rather than on the entire credit limit. This means that you can make more cost-effective use of the facility when compared to other forms of finance, such as term loans, where interest is charged on the entire amount borrowed. However, revolving credit facilities aren't without their risks. One of the key disadvantages is the possibility of becoming over-reliant on the credit facility, leading to increased debt levels in the long run. This can exacerbate your financial situation if not managed carefully. Charges are another potential drawback. RCFs often come with various fees, such as setup fees, annual fees, and transaction fees, which can add up over time. Additionally, the interest rates for revolving credit facilities can be higher than those for other types of finance, increasing your overall borrowing costs. In conclusion, when considering whether a revolving credit facility is the right choice for your business, it's crucial to assess the advantages and disadvantages carefully. It is essential to strike a balance between the convenience and control offered by RCFs and being mindful of the potential risks and charges associated with this type of finance. Understanding interest rates. When considering a revolving credit facility, it's essential to understand how interest rates work. Interest rates are the cost of borrowing money, which is expressed as a percentage of the loan amount. In the context of an RCF, interest is usually charged on the outstanding balance you have drawn down. There are two primary types of interest rates, fixed and variable. A fixed interest rate remains constant throughout the loan term, giving you predictability and stability in your repayments. On the other hand, a variable interest rate is subject to change based on market conditions, allowing for potential savings if rates decrease but also exposing you to the risk of increased costs if rates rise. Additionally, revolving credit facilities often have flexible repayment options, such as interest-only repayments. With interest-only repayments, you are only required to pay the interest on the outstanding balance each month, giving you the option to repay the principal when it's financially suitable for you. Here are some key aspects to consider regarding interest rates in revolving credit facilities. Ensure you have a clear understanding of the interest rate being offered, and whether it's fixed or variable. Keep an eye on market fluctuations if you've opted for a variable interest rate, as changes can affect your repayment costs. Factor in the possibility of interest-only repayments in your cash flow planning, ensuring you have a strategy for repaying the principal balance. By keeping these points in mind, you can effectively navigate the world of interest rates, and select a revolving credit facility that aligns with your business's financial needs and goals. Remember, having a comprehensive understanding of the interest rates you're being offered will empower you to make informed decisions and optimize your use of a revolving credit facility. Repayments and fees. When it comes to a revolving credit facility, RCF, understanding the repayments and fees involved is essential for making the most of this flexible financial solution. In this section, we'll cover key aspects of repayments and fees, ensuring you feel confident and knowledgeable about managing your RCF. In an RCF, you typically only pay interest, usually at a fixed rate, on the amount you've borrowed, not the entire credit facility. This means that if you haven't withdrawn any funds, you won't have to make any repayments. Additionally, interest rates are often calculated daily, giving you more control over your repayment schedule. Another essential part of RCFs is the absence of early repayment fees. This means you can repay your borrowed amount as quickly as you'd like, without facing any penalties. By repaying your loan early, you can significantly reduce the overall interest paid and maintain a healthier financial standing for your business. However, it's important to familiarize yourself with any other fees associated with the RCF, such as arrangement fees, commitment fees, or non-utilization fees. The arrangement fee, typically a one-time payment, is charged when setting up the facility. The commitment fee refers to the percentage charged on the unutilized portion of the credit facility. Non-utilization fees may be applied if you're not using a certain percentage of the facility. To avoid any unexpected costs, thoroughly review your RCF agreement and have a clear understanding of all fees involved. By doing so, you'll be better equipped to manage your finances and make informed decisions about how to use your revolving credit facility efficiently. Comparison with other credit facilities. When exploring financing options for your business, it's essential to understand how a revolving credit facility compares to other credit facilities. This will help you make an informed decision and choose the right solution for your financial needs. A revolving credit facility provides flexible access to funds within a predetermined credit limit, allowing you to draw and repay funds as needed. Interest is charged only on the amount you withdraw while it's outstanding. This type of facility can be a beneficial source of working capital finance for businesses looking to grow, expand, or manage their cash flow efficiently. On the other hand, a bank overdraft is an arrangement with your bank that allows you to spend more than the available balance in your account, up to a certain limit. Bank overdrafts typically charge interest on the overdrawn balance and may also include additional fees. While overdrafts used to be a common form of financing for businesses, they have become increasingly difficult to obtain from traditional high street banks too. Credit cards represent another form of revolving credit, although they are more commonly used by consumers. Business credit cards offer a convenient way to manage expenses and often provide some benefits, such as cashback or reward points. However, credit card interest rates can be higher than those offered by revolving credit facilities, and they may not be the most cost-effective option for businesses with larger financial needs. Comparing these options, revolving credit facilities offer more flexibility and control than overdrafts and credit cards. With a set credit limit and the freedom to draw and repay funds as required, you can tailor your financing to your business's specific needs and manage your cash flow more efficiently. Unlike bank overdrafts, revolving credit facilities are becoming more readily available to businesses through alternative lenders, providing an accessible solution for growth and expansion. In summary, while overdrafts and credit cards can provide short-term financing solutions, a revolving credit facility offers the flexibility and cost-effectiveness essential for businesses looking to manage their cash flow and invest in growth opportunities. Make sure to consider all aspects of each financing option before making your decision. Determining eligibility. When considering a revolving credit facility, it's crucial to understand the eligibility criteria. Lenders evaluate various aspects of your business and financial profile to determine your suitability for this financing option. By being informed about these factors, you can better assess your chances of obtaining a revolving credit facility. Credit history and credit score. Your personal and business credit history play a significant role in your eligibility. Lenders analyze both your personal credit score and your business credit history to assess your trustworthiness and ability to repay the borrowed funds. A higher credit score and a clean credit history with no defaults or late payments can increase your chances of getting approved. Make sure to review your credit history and correct any inaccuracies before applying. Business financials. Lenders need to have confidence in your business's financial stability. They'll consider factors such as your revenue, cash flow, and profitability before determining your eligibility. A strong financial performance with consistent revenue growth and positive cash flow is likely to improve your chances of securing a revolving credit facility. Maintaining accurate financial records and staying informed about your business's financial performance is crucial. Assets as collateral. In some cases, lenders might require you to provide assets as collateral to secure the revolving credit facility. These assets can be physical property, equipment, or even outstanding invoices. Offering collateral demonstrates your commitment to repaying the borrowed funds, and can make it easier for you to meet the lender's eligibility requirements. Be prepared to provide details about your assets when discussing revolving credit facility options with potential lenders. Evaluation of risk. Lastly, lenders evaluate the overall risk associated with your business when determining your eligibility. Factors such as industry, market conditions, and competitive landscape are taken into account. If your business operates in a stable industry with strong market conditions and a healthy competitive landscape, your chances of being approved for a revolving credit facility could be higher. In summary, understanding the factors that influence your eligibility for a revolving credit facility is essential, as it will help you prepare your application and increase your chances of approval. Focus on maintaining a healthy credit history, strong business financials, and securing your assets to demonstrate your commitment to repaying the funds. How do revolving credit facilities differ from term loans? Revolving credit facilities provide you with flexible access to funds, allowing you to draw and repay amounts up to a predetermined limit as often as required. On the contrary, term loans involve receiving a lump sum upfront that you must repay over a fixed period with regular installments. Revolving credit facilities are more suitable for addressing short-term cash flow needs, whereas term loans are commonly used for long-term investments or projects. What are the main benefits and drawbacks of a revolving credit facility? The major benefits of a revolving credit facility include its flexibility in addressing cash flow fluctuations, no early repayment fees, and interest only charged on the amount utilized. However, the drawbacks may consist of higher interest rates compared to traditional term loans, the requirement of collateral or personal guarantees, and possible fees for setting up and maintaining the facility. Which providers offer revolving credit facilities? Several providers offer rotating credit facilities. To work with a loan broker can put you in touch with the most suitable lender for your needs. It is essential to research and compare different lenders to find the most suitable revolving credit facility for your business needs. How does a revolving credit facility impact a company's balance sheet? A revolving credit facility impacts the company's balance sheet by appearing as a short-term liability, current debt, when amounts are drawn. As you repay the facility, the liability reduces. Meanwhile, when funds are drawn, the company's cash balance increases, leading to an improvement in working capital. When repaying the facility, the cash balance will decrease, causing a reduction in working capital. What is the typical maturity period for a revolving credit facility? The maturity period for revolving credit facilities can vary significantly depending on the lender and the borrower's requirements. Typical maturity periods range from 1 to 5 years but can be shorter or longer based on the agreement between you and the financial institution. What are the key differences between a revolving credit facility and a line of credit? Revolving credit facilities and lines of credit share similarities, such as access to funds up to a predefined limit and flexible repayment options. However, there are differences. Revolving credit facilities are often secured with collateral, while lines of credit can be secured or unsecured. Additionally, revolving credit facilities may come with higher interest rates and are generally more suitable for short-term financing needs, whereas lines of credit can be used for both short and long-term financial requirements. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.